In the Chapter 10 exercises, we will be looking at the various items related to property, plant, and equipment, intangible assets as far as acquisition and disposition. So let's take a look. In exercise 10-3, Remsen Manufacturing purchased land and a building for $2 million. In addition to the purchase price, they made the following expenditures in connection with the purchase of the land and the building: title insurance, legal fees for drawing the contract, prorated property taxes for the period after acquisition, state transfer fees. An independent appraisal estimated the fair values of the land and building if purchased separately at $1.8 million and $0.9 respectively. Shortly after acquisition, Remsen spent $67,000 to construct a parking lot and $32,000 for landscaping. First of all, we need to determine the initial valuation of each asset acquired in these transactions. Then we will repeat requirement 1, assuming that immediately after acquisition, Remsen demolished the building and that information that's present. Let's take a look. So, how do we determine how much of the purchase price of $2 million should be allocated to the land and the building? We use an allocation based on the fair market values of each separately. So, oh, by the way, first of all, we need to add in the purchase price. Not only that, we need to also add in title insurance, legal fees, because this was all part of that joint asset purchase, state transfer taxes. The property taxes for the period after acquisition will actually be an expense. If these were property taxes for before the acquisition, so they were actually back property taxes of the previous owner, those would have been added in here. So the total cost, $2,017,200. Now, how do we allocate that $2,017,200? Based on the fair market value, or the allocation of fair market value to each asset. So we say, how much was the land if we just bought the land? How much is the building if we just bought the building? If we bought these assets separately, they would have cost a total of $2.7 million. But because we bought them together, we were able to pay less. So we determined the percent each is of the total fair market value. So 1.8 million divided by 2.7 million, 66.67% of the fair value is allocated to the land. 33.33%, or the $900,000 fair value of the building, divided by the 2.7 million total fair value, is allocated to the building. So we take the total cost of $2,017,200, and 66.67% of it is how much will be allocated into the land account. 33.33% of the total cost of $2,017,200, $672,400, will be allocated to the building. So we would debit the land and the building for those amounts. The land improvements would also change. Parking lot and landscaping are under the fixed or property, plant, and equipment. Whoops, sorry, I went to number 2, but they are under the property, plant, and equipment land improvements. Now it says repeat 1, but assume some other stuff here. Remsen demolished the building. Demolition costs were $990,000, but they were able to salvage some materials and sell them for $4,600. In addition, they spent $64,000 clearing and grading the land in preparation for the construction of a new building. Well, now our costs will change. The cost of land will be the purchase price, $2 million, title insurance, legal fees, and the state transfer fees. In addition, the demolition of the old building will be included, but the subtraction of the materials will be subtracted because that's like a revenue. It's like they paid less for the demolition of the old building. Also, they have to clear and grade the land for $64,000. So now the total cost is at $3,066,660. The parking lot and landscaping, $67,000 and $32,000. You may ask yourself, why isn't anything allocated to the building? Well, because they didn't keep the building, they demolished it. And that building was on the land, and the land was not ready for its first use. So we don't do anything to the building account. Everything would have been debited to the land. In exercise 10.5, we have Aztec Corporation was organized early in year 1. The following expenditures were made during the first months of the year. Prepare a summary journal entry to record the $113,500 in cash expenditures. So basically they're asking us, where would this information be recorded? The attorney fees, the state filing and other corporation costs would be debited to organization cost expense. The purchase price of the patent, as well as the legal fees for the transfer of the patent. When you're buying an intangible asset, such as a patent, and you have legal fees associated with it, you debit the intangible asset patent. The purchase price of the furniture, that would be debited to furniture. And the pre-opening salaries would be debited to pre-opening expenses. And then we would credit cash. Exercise 10.6. Here we have March 31st, year 1. Michael Brothers Corporation acquired all of the outstanding common stock of Moser Corporation for $20 million in cash. The book values and fair values of Moser's assets and liabilities were as follows. Calculate the amount paid for goodwill. Well, in this circumstance, first of all, to calculate goodwill, we first look at the fair value of the net assets. Net assets being assets minus liabilities. So, the net assets would be $24 million minus the fair value of the liabilities of $8 million. So the $8 million plus the $13 million plus the $3 million would give you the $24 million, minus the current plus long-term liabilities, $16 million. Remember what goodwill is? It's the amount that is paid for the amount paid above the fair value of the net assets. Here's how you could look at it. If you bought all of the assets of Moser and you sold them, you sold $24 million, you would have $24 million in cash. You would then have to pay off $8 million in liabilities. So really, you have $16 million of value when you buy this company, but you're paying $20 million for it. You're paying more for it than it's worth. Not because you don't know what you're doing, but because there's very intangible aspects of the company that will make it more profitable. Things like great management, great employees, great customers who are loyal. And these aren't valued anywhere until Michael Brothers purchases Moser's assets and liabilities. And they place a value on those really intangible great things of the company at $4 million. In exercise 10.14, we have Zomtron Company recently traded in an older model computer for a new model. The model's book value, old one was $216,000, cost $480 minus accumulated of $264. Its fair value was $240,000. Zomton paid $72,000 to complete the exchange, which has commercial substance. So this is a like-kind exchange. The journal entry to record this trade is to credit the old model's cost $480 and debit the accumulated depreciation related to the old model. So you remove that asset off the books. The fair value that you could have sold it for was $240,000. You traded it with a book value of $216,000. So there's a gain on the exchange of $24,000. The fair value of the old computer, $240,000, so what they gave up, plus the cash paid is how much the new computer's cost is. So when you trade an old asset for one just like it, you're upgrading basically. This is how you compute the gain associated with that transfer. And take the old asset off the book and put the new one on. And then you would depreciate the equipment that you just purchased with the old equipment plus $72,000. Exercise 10-23. This is on, actually in your book. It is on page, the details of it, I just have the answer key there, on page 560. So on January 1, the Chagrin Company began construction of a new manufacturing facility for its own use. So this is a self-constructed asset. The building was completed the following year in 2019. The only interest-bearing debt the company had during 2018 were bonds with a book value of $10 million and an effective interest rate of 8%. They give us the expenditures for the year for 2018 and ask us to calculate the amount of interest to be capitalized. And I apologize how this transferred over. But this first calculation, remember, the first thing we want to do is find our weighted average accumulated expenditures for the year. So what we're basically doing here is we're saying, okay, we paid $500,000 on January 1. If we had to borrow that money, how many months of this year would we have to have calculated interest on that? 12 of the 12 months. So we weight that payment $500,000. The next payment was made March 1st, $600,000. Again, if we borrowed the money, how long would we have to calculate interest on that? Well, for 10 of 12 months. So we're only going to use 10 of 12 of that payment in determining interest, or $500,000. The July 31st payment. Again, we paid $480,000, but if we borrowed that money on July 31st, how many months would we have to calculate interest for? Well, 5 of 12 months. So we're only going to use 5/12 of that payment in our interest calculation, or $200,000. The September 30th would be computed the same way. $600,000 was the payment. How many months would we have to have computed interest for? 3 of 12 months. So only 3/12 of that $600,000 payment will be used to calculate interest for the year. And then finally, the December 31st payment. Well, we wouldn't have had to calculate any interest if we borrowed that money on December 31st. So none of that payment will be included. What we do is add up each of the results we calculated for each payment. So the $500,000 plus the $500,000 plus the $200,000 plus the $150,000. $1,350,000 of the expenditures will be used to calculate interest on this construction. And we're basically trying to figure out how much interest would have been avoided if we didn't do this construction. So we take that weighted accumulated expenditure there, $1,350,000. Since there's only one loan outstanding for the year, we use the interest rate on that loan, 8%. So the interest that should be capitalized for the year, $108,000. So that's a very straightforward approach to interest capitalization. 1024, we're going to get a little bit more in depth. In 1024, the next page, January 1st, the Highlands Company began construction of a new facility for its own use. Again, self-constructed asset. It was finished the next year. The company borrowed $1.5 million at 8% on January 1 to help finance the construction. So this was borrowed specific for the construction. In addition, they had other loans outstanding during 2018. They had a $5 million bond that pays 12% interest and an 8% $3 million long-term note. Then they give us the construction expenditures. Again, our first step is figure out how much of these expenditures should be used to calculate interest. And it all depends on, and this is how you look at it. If we had to pay interest on these expenditures, how long would we have had to calculate interest for from the payment through the end of the year? So as of January 1, we would have calculated interest on all $600,000. Again, I'm sorry for how it transferred over from my answer key. I should have fixed that beforehand. So 600,000 times 12 twelfths, 600,000. The March 31st expenditure, we would have had to calculate interest on that for 9 of the 12 months, the remaining 9 months of the year. So 1.2 million times 9 twelfths, $900,000. The June 30th expenditure, we would have had to calculate interest on that for 6 of 12 months, or 400,000. The September 30th expenditure would have had to have interest calculated on it for the 3 remaining months of the year, or 3 twelfths. So 600,000 times 3 twelfths, only 150,000 of that will be used to determine interest for the year on this construction. The December 31st, none of it would have been calculated interest on it, so we don't include any of it in how much of our expenditures should be used to calculate interest. So we add up the 600,000 plus the 900,000 plus the 400,000 plus the 150,000. $2,050,000 are the expenditures from our construction that will be used to calculate interest. Now, when we're calculating interest, the first question we ask is there a loan specific to the construction? Oh yeah, $1.5 million. So the first $1.5 million of that $2,050,000, we will calculate interest at 8%. So the interest that could have been avoided from this construction loan, $120,000. Now, there's still $550,000 of expenditures to calculate interest on, but at what interest rate do we use? Well, the rules say take all your remaining debt that has interest and come up with an average interest rate from all your other debt. So we're going to take that $5 million bond times 12%. The normal interest paid during the year is $600,000. We're going to do the same thing with the long-term note. How much interest is there on for the year on that? $3 million times 8%, or $240,000. So of the 2 additional debts that total $8 million in principal, the company would pay $840,000 in interest. Well, what's the average interest rate then? 840 divided by 8 million, 10.5%. So the remaining expenditures we have to calculate interest on, the $550,000, we will calculate interest at 10.5%, $57,750. So the amount of interest that will be capitalized, $120,000 plus $57,750, or $177,750. That's how you run interest capitalization. In exercise 10-25, we're going to kick it up a notch. Now we're going to take a project and show how you do the interest calculation if it runs from 1 year into the 2nd year. So we have information there for year 1 and year 2 related to a construction from Kiron Industries. They began their construction on July 1 of year 1. The project was completed on March 31st of year 2. There were no new loans required to fund construction. Kieran does have the following 2 interest-bearing liabilities that were outstanding throughout the entire construction period. So let's start with year 1. We first average our accumulated expenditures. So in July 1 of year 1, to calculate interest, since this wasn't outstanding the whole year, it was only outstanding for the last 6 months of the year, we would calculate interest on 6 months of the remaining 6 months, or $500,000. For the September 30th, we would calculate interest on 3 of the 6 months the construction was alive during the year 1, on the $600,000, or $300,000. And then the November 30th, well, we would only have to calculate interest on 1 of the 6 months it was outstanding during the year, or $66,667. So we use the 6 in the denominator because the construction started during the year. So the total expenditures were $1.5 million, but we only have to calculate interest on $866,667 of them. Further, now we have to find a weighted average rate. Remember, we have a $3 million note at 10%, so that would produce $300,000 in interest, and then a $7 million, is it a bond? I can't remember off the top. Yes, bond that produces 5% interest, or $350,000 of interest each year. So take the $650,000 in total interest divided by the 10 million, 6.5% is the interest rate. Calculate your interest by taking 866,667 times 6.5%. Now remember, that's a 12-month interest rate. We only need interest for 6 months because construction went from July 1 through December 31st. $28,167. So you would debit the building account, credit interest expense if you had already recorded that in interest expense for $28,167. Okay, so in the second year, let's see how we would do our calculations. There was only one construction expenditure, and it happened in January. Now remember, when the construction ended 3 months later. So, I'm sorry, from January 1 through March 31st, we open our year up with our $1.5 million in expenditures because we should still calculate interest on last year's expenditures plus the capitalized interest from last year. We also need to calculate interest on that as well. So that's where you start year 1 at. Last year's total expenditures plus interest capitalized. Now, the construction period only lasted 3 months, so we would have to calculate interest on them for 3 of 3 months. Then the January 30th, well, it's a $550,000 expenditure. We would only need to calculate interest on that for 2 more months till the construction period ended. So the total expenditures that you should capitalize interest on for the second year, $1,894,834. Use the same interest rate as last year because the loans didn't change. So $1,894,834 times 6.5%. Remember, that's a 12-month interest rate. We only need to calculate interest for 3 of 12 months. So the interest capitalized in year 2, $30,791. So that's how you account for a project that goes from 1 year to the next year and determining the amount of interest to capitalize related to that project. Interest capitalization means you're going to debit the asset for that amount of interest. Okay, so that is the end of our presentation. I did have exercise 10-33, but it's actually almost exactly like one of the first exercises we looked at in the beginning. So please take a look at all this information and let me know if you have any questions on the discussion board.